Welcome to the Dividend Talk podcast, episode 205. Is L'Oreal worth it? Dividend Talk is your number one podcast for all things dividend and stock market related with a unique European flavour. My name is Derek from Engineer My Freedom, and I'm joined with my co-host, European DGI. If you want to learn more about us, please visit europeandgi.com, where we have articles on dividend growth investing, including 30 European dividend aristocrats. While you're there, you might as well grab our free dividend portfolio tracker template. We also offer a premium dividend growth service featuring a bi-weekly newsletter, which includes stock deep dives, dividend stock cards, and access to our dashboard with over 130 dividend growth stocks. All of this is based on our very own dividend safety analysis. But enough about that. Please grab a cup of coffee and let's get started. Hey, European DJ. It's nearly vacation time.
Yes. I know. And that's why we are recording this one a little bit earlier. Because I'm going for almost 3 weeks on vacation. You're also having almost 2 weeks of vacation uninterrupted. So, let's record this one early so that in the weekend of the 20th of July, 21 July, people have something to listen to. The weekend after is still at risk, right? You try to make a recording, but maybe it won't work out. But I think our listeners will forgive us for one time. Maybe we can even throw in an old episode as a memorial or something like that in there. But look, really looking forward to it. I need it. I need to really disconnect a little bit. It's been a tough year at work, our side hustle, or let's say our dividend safety, dividend growth compass work that we've been doing. It's actually more than a side hustle for us. It's actually work, I wouldn't call it, but there's quite a commitment behind it. But it's also really great. We have more than 70 to 80 stocks or something analyzed just in the last 9 months or something like that. All their dividend safety ratings and everything, right? So we're really building up a database right now. I'm also very proud on that. Many European stocks in there. And one thing we wanted to do today is have a little bit of a different topic, because we won't have news on the week if we are gone during cucumber time. So we really wanted to take a stock deep dive. We did a business breakdown for Realty Income one time. It's actually one of our most listened episodes ever. Well, I don't have the same expectation maybe today, but who knows? But I think it's really nice to one time do a business breakdown for probably the most iconic company we have in Europe, specifically even from a dividend grower point of view. But I would even say without that, the same would apply.
Absolutely, yeah. And I think it's actually quite important to do a deep dive on L'Oreal. And why? Because anytime we're asked a question about quality European companies, it's usually one of the top 3 companies we say. And I remember way back at the beginning of this podcast, we used to put Unilever and Danone there. We maybe should have done more deep dives on the podcast about those, because I don't think people quite understood why we were so bullish on them. We may or may not have been right when you fast forward 4 years. So I think it's actually a good opportunity to show what we've analyzed, what we researched with L'Oreal, and why we think they are such a quality company. And I love their tagline, because I'm worth it. So that is why we've titled this, Is L'Oreal Worth It? But yeah, L'Oreal, iconic company. I think every European must know this company. 60 years of dividend growth. I mean, that's why we're talking about them, right?
Yes. 60 years of dividend growth. And even the last 25 years, it has been compounding the dividends at 11.3% annually. I mean, even this year, it grew the dividend from €6 to €6.60. Yeah, these, if you start to look at the dividend charts, it's really an exponential growth. It's amazing, and it's been doing this for many, many years. We only see this with Visa or something like that, right? If you look at the American equivalents, but what L'Oreal's been doing is really, really amazing. And what I mostly like about this company, at its core, it wants it wants to make people feel beautiful, right? It was originally always around women, but nowadays is also for men. And this is something, if you think about the mission and everything that they're on, it gives you such a wide range of opportunities as a company, because
Yeah,
it's universal. Everyone wants to be at their best, right? Whether you're discovering love for the first time and you want to impress the other half, or later on when you need to show up at work. Yeah, there are always these kinds of moments in life where you want this and where you need that. And the beauty of L'Oreal is that they have products for each and every stage of those moments that matter in life, right? And I think that's what makes this company so iconic. And it's not just limited to the Western world or Western Europe thinking. It is everywhere. It's a global powerhouse.
yeah, yeah. I don't know if you feel the same, but when I hear the name L'Oreal, I almost feel like it's luxury. It's a luxury brand, even though it's not. It's aimed across pretty much all income levels. I mean, you can be any income level and own a L'Oreal product. But I always get that premium feel for that, and I think that's a quite unique proposition from a business.
Yes, 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 definitely. And I think, there are typically those presents that you have also under the Christmas tree, right? I'm looking at the picture of all the history of acquisitions, and every year they're buying a lot of companies again. And for instance, Yves Saint Laurent, right? It's a company that you can typically see under a Christmas tree
Yeah,
there. But they have Vichy, yeah, those skincare products as
yeah,
well.
yeah,
Of course, Prada, they have, it's a more recent acquisition, Santé, and the list goes on and on and on, right? And uh, I had the same experience with Louis Vuitton. If you start analyzing those brands that they own, you really recognize a lot of them.
yeah, yeah. And look, I think it's quite important to say that acquisitions play such a huge role with L'Oreal. Like you've mentioned some of those companies. It's hard to grow to such a large iconic brand with many
Yeah,
different sub brands underneath them without acquiring. So it is
yeah,
critical. But they've been doing such a good job of that over the last 20 years. You've mentioned 3 or 4 brands there, all top quality, but integrated
yeah.
seamlessly into L'Oreal.
And I think this is the secret sauce of this company. They know how to do this. They know how to acquire companies that are, most of them, straight away accredited to the bottom line numbers. They let them benefit from the entire sales force that they have, the online channels that they have, so they can also quite quickly scale the sales of those brands, right? Because they come with a whole supply chain and economies of scales that such a brand on its own can never afford, right? And that's really unique, and why it's also so attractive for a company as L'Oreal to buy those iconic brands at a reasonable price.
Yeah, yeah. So some interesting facts. I read your article. So you done a deep dive on these, and I have to say it was the first one that we've done on the newsletter, but it was quite in depth and really enjoyed it actually. But some facts about the company that really, really stuck out to me. Um, and the first one is around Nestle. So they have about a 20% stake in Nestle and a
No, the way
10.
around. Nestle has a
Oh, sorry.
20%
Yeah,
stake
yeah,
in L'Oreal.
yeah.
Yeah.
And then Sanofi as well. Do they have 10% in Sanofi?
Yes, they have 10% in Sanofi, and this pays almost 500 million of dividends each year. Yeah, which is also very interesting.
So does that make L'Oreal a dividend investor, dividend growth investor?
I think so. I think so. Yeah, I think so. Yeah, but also the main shareholder, right, is the one of the late, I don't even know how you call it, granddaughters or whatever it is. It's Françoise Bettencourt. She's the richest woman in the world. She owns about 80 billion she has about 80 billion in wealth, mostly due to her stake in L'Oreal, which is insane. I mean, 80 billion. So she has, of course, also a large influence in the French society, and yeah, she's a billionaire per sang. It's amazing how someone can have so much wealth. This how is it concentrated in a single asset? If you think about it, yeah. So it's really following a bit Warren Buffett's philosophy as well. Like, why would you diversify?
Yeah, I mean, 35% in a company giving you 80 billion. We talk about diversification, but I mean, there's conviction. That's a lot of conviction.
Yeah. And you know, the good thing is, I think if you in her case, I understand that if you look at all the brands, this company is not going to die overnight. If one brand falls down, there's still 30, 40 other brands that will do the heavy lifting. So it's in itself, it's actually like already a holding company with different unique companies below it. I would argue.
Yeah.
Yeah. And then so this underlying, let's say, structure of the company is very sustainable and set up for growth for the long term, which is really, I think, good if you're an investor in this company, because I think the incentives pretty much align.
Yeah. Yeah. And you're speaking about growth over the long term. So what are some of the main catalysts that you saw in the company?
Well, first of all, I think what they have experienced, of course, is the wave of globalization in the first 20 years of this century, like many other companies. I guess L'Oreal has been able to outperform many other companies because of its global brand appeal. I mean, everyone knows the L'Oreal lipstick as an example, also very popular in all the movies. So this made it enter the markets and, for instance, do a lot of business in China. Yeah, but at the same time, there's more and more awareness also for health, personal care, overall appearance, which is really a phenomenon observed worldwide. Yeah. So whether it is like maybe in the Chinese culture, more the prevention of sunlight, right? And a 10, and maybe in other areas of the world, like Europe, it's again, we want a 10. So, and they have cosmetics for all of this. Yeah. So and then this, I think, is one of those very interesting catalysts as well, because I think it's there to stay, and it will only be stronger and stronger with everything on social media and such, in the lives we live nowadays. Whether you like it or not, that's another thing, right? But we look at it from the company perspective. I also feel like there is simply, we talk a lot about woke, right? Maybe not about woke, but this is a trend that we have seen where Unilever and such really went into this. I think for a company like L'Oreal, it's different. And why I'm saying that, their consumer base directly has requirements, for instance, for sustainable products not tested on animals or something like that. There are a lot of those. So in this case, I think the sustainable health trend is something really in the favor of L'Oreal, because, simply said, it allows them also to charge premium prices for this. Yeah. And this company is doing that really smart here, because it's really a direct to consumer business. I also see a strong middle class rising in emerging countries. Think about the potential of India and the billion people there. Yeah. If they all get to enter the middle class, they will all, if I hear the stories from my family, for instance, in the 70s when they were living here, if someone from Germany would bring a Barbie, as an example, that would have been like the present of their whole youth, having a Barbie, and because you couldn't acquire that stuff here, or you didn't have the money for it either. So take this also to India, maybe to the lower income areas. The kids there, if they already go to shopping mall, they probably can't get further than watching at the window outside and looking at all these products. But imagine that these kids or teenagers today start working, God knows where, in IT or something like that, and this whole country becomes more and more middle class. What do you think that they will be presenting themselves with under the Christmas tree?
Yeah, 100%. I mean, we don't talk about India or emerging markets a lot on this. We get asked questions, but I think it's quite clear that growth opportunities that can potentially come from that country. It's hard to imagine it as European, because we have all of this readily available. It's we know what it's like to have it there. So I can only imagine going to India and they seen it for the first time. Like you said, it's when someone gives it to you from another country, it's the best present ever. So that could explode. We don't know when, but eventually you would
Yeah.
have to think India will come on the scene. And what would that do to a company like L'Oreal? Maybe double, triple their revenue. Who knows? Like,
I don't know if I'm that bullish, but it, if you look at L'Oreal today, I think 47% of the growth over the last several years came from China alone.
Yeah.
Yeah. So I think we can look at those numbers as well. Maybe India or such a country will start adding maybe 5 to 10% of the overall growth, share of growth. Yeah.
yes.
In those years, but generally this also means that it can help pull the company a bit forward again. So definitely the further globalization, rising emerging middle class, but also things like, these are all these little trends that you see. For instance, grooming. Yeah, men with their beards nowadays and everything, and the attention they pay to their skin and how the beard looks like. These are the things that L'Oreal is also actively looking at. And what is the nice thing about L'Oreal? They are really good in also creating trends. Yeah, remember, this is a French company. France is still a country where a lot of fashion and beauty is being shaped in trends for the upcoming years, right? So L'Oreal is in the epicenter of this.
Yeah, and the men grooming is an interesting trend, especially among the younger generation, I have to say. I look at some of the teenagers, some of my nephews, and man, their grooming products, they have more than my wife. It's crazy. And they have these skincare routines going to bed, they have these hair routines. I'm like, all I needed was shampoo and it did everything. So
When I think about this, they must be as slippery as an eel.
but
Imagine oiling them; you could never touch them. They would just slip out of your hands like straight away. Like,
they're like a damn Triore for wolves, just in baby oil. But it's, I mean, I think that's the way the world is going. Even little things down to hair dryers, they all styling their hair with hair dryers and straighteners. Like, it's just,
but we use gel in those times. Come on, we had those spikes on our heads, yeah, with
we
a
did.
liter of gel.
But that took me about 20 seconds. They're spending like half
Yeah.
an hour on that. I would not have the patience.
Well, that's why we're both bald.
Exactly. Maybe we should have used L'Oreal products, but yeah, I think the men's one is quite an
Yeah.
interesting one, and I think that has some way to go as well. It'll be harder to transform some of the older generation like myself.
Yeah.
But certainly younger generations will buy into it.
Yeah, what is, if you think about the catalyst, we look a little bit further, right? L'Oreal is by far the largest player in this industry. It makes around 41 billion in turnover in the last year. Who's the second one?
I would have said somebody else because I have the graph here now. I would have definitely said Estee Lauder if I was to pick. But it's
fun
not.
fact, it's Unilever.
It's crazy, right?
Yeah, Unilever is also really huge in the beauty and care industry, and they make around 24 billion in sales each year. Of course, totally different products, but still, it is kind of in a competition with L'Oreal, but more at other price segments and other distribution channels, right? But other than that, is Estee Lauder, Procter and Gamble, Shiseido, LVMH, also a little bit, of course, Chanel. So, but they are just able to harvest most of the revenue, and there's still enough in this market for them to grow. There's still enough to acquire, which is also interesting after this entire history there.
Yeah. So what about the segments then? Like we spoke a bit about the catalysts. I know they're in maybe four segments. Professional products. So you've got, I don't know these companies quite well, I must admit, but you've got companies like Redken and it's like Keratache.
Yeah.
So probably aimed at professionals, hairdressers, beauty salons,
Exactly.
and those kinds of things. My wife would probably know them more than I would. But then we've got the consumer products, and I think that's where everybody would know L'Oreal. We have Maybelline. Everyone knows the adverts. You have all these. Maybe it's Maybelline. You've got Garnier, which is the shampoo I used to use before I went bald.
What do you use now for your head then? You don't use shampoo anymore?
We have this shower gel, this all in one, and then moisturizer.
The cheap ones from the Action store. And
I know. I think my wife has gone mad into these plant-based moisturizers. So every time I come out of the shower, she's following me
Oh, there
around,
you go. The
whispering
sustainable
your
one.
head.
She's
Yes,
paying premium pricing.
exactly. Yeah, yeah. So
Yeah.
before every time I shave my head or do anything, I have to put this on. So it's hey, look, I have a skincare routine. I didn't even know it.
There you go. Maybe it's even L'Oreal.
Yeah, yeah. And a couple of the other industries they're in is obviously their luxury one. So you got Prada, you got Armani, Lacome as well, and then there are active products, and you mentioned Vici and
Yeah.
Karevi. But what's quite interesting is apart from professional products, because I'm not in that
Yeah.
industry, across the other three, it's hard not to know all those brands, which
Yeah.
is quite a feat. I have to say.
Go into a regular shopping mall, like a warehouse where they have those floors with all the luxury and the cosmetics. You will typically see all those brands there. Probably even it's a L'Oreal corner or something like that without us even knowing.
Yeah,
But just maybe a few facts here, right? The consumer products business is their largest segment with 37%. But luxury is similar, also 37%. Then we have dermatological beauty, right? That we spoke about, the active cosmetics, which is around 16%, and then professional products around 11%. But more interestingly, Europe is still the biggest segment with 32%. 28% is North America, 25% North Asia, and then still some Latin America and submina, as they call it. But their biggest category by 40% is skincare and sun protection. Now, this sun protection is really when we talk about Asia. And makeup, so the lipstick and such is in the end 20%, their second biggest category. And what I find fascinating here is that Europe was also one of the largest growers during this inflationary time, where other continents were struggling. Europe was for the first time pulling it up, and you don't really hear that often, right? That Europe is pulling an industry forward, and we have seen that here with L'Oreal, and I believe LVMH had the same.
yeah.
So I guess we were easier to be fooled with higher prices there, I would say.
Yeah, yeah, but I have to say I was a little bit surprised when you say Europe is the biggest region. I would expect them to be a significant portion, yes, but
Yeah,
honestly, I thought North America would be higher than Europe and also Asia. So what that tells me is there's still room to grow. You mentioned it about the market is there's still some
yeah,
market to grasp there, and I think America and Asia are obviously two that they can target.
definitely. But look, what is maybe even more impressive, that this company has effectively no debt. They have 4.4 billion in net debt. Yeah, but this is based on operating profit of 8 billion. And I mean, they can pay off their debt in a single year, no issue there. They just need to, do a little bit of cost saving, and they pay out almost the entire debt straight away. So this company is so well financed, and this is what you see, right? Those growers that with hardly any debt, they are also able to grow because nothing is really holding them back. The
Yeah.
money is flowing back into the company, not to the banks that they need to pay off for their debt.
Yeah.
So generally speaking, what is good to know probably is that while we spoke about consumer products and we spoke about the professional products first, actually what's really pushing them forward are the active cosmetics division and the luxury division. Those are the two divisions that are really pushing this company forward. The rest is a little bit flattish, I would say. And like I mentioned before, if you look at over the last decade, China, North Asia was responsible for half of the annual sales growth. So I think that's important to mention, because it means if China really starts to deteriorate significantly, because there's geopolitical tension there, God knows what happens if they want to ban European products or whatever, then there's quite some earnings risk here related to the company.
Yeah, yeah, and I think we spoke about that in one of the recent episodes. Maybe it's not so recent. Actually, it all rolls into one, but we have highlighted the risk China plays here.
Yeah.
It's a huge portion of their revenue. So I think it would be irresponsible to ignore that. You have
Yeah.
to be quite aware of that. So, but I mean, I don't see it as a huge risk at the moment. I
Mhm.
think it'll take a couple of years for that to play out. And as you said, there's other markets there that they can go into, and if
Yeah.
they can offset some of that, it'll be much better. But I'm impressed with that net debt. We talked about their acquisitions, and how do you acquire that many? There's too many to list, but how do you acquire that many companies and still have virtually no debt on
Well,
your?
free cash flow. Free
Yeah.
cash flow is king. If you have a relatively low dividend payout ratio, which I believe stands at about 50% right now,
Mm.
then you have the other 50% left to invest. And those brands, if you pay a few billion for that, because remember, we're talking about brands here that are quite large, but they are not like 20, 30 billion brands. Yeah, it's a half a billion here, a billion there. Effectively, they're funding it out of their free cash flow. And those brands also bring in free cash flow straight away as well. So it's really then about the return on invested capital for these kinds of brands. And that's so impressive with this company. And that's why also their EPS was growing about 11.3% over the last 5 years on average, right? Pretty much in line with their dividend growth, I would say.
Yeah, yeah. Which is, I mean, I think it's really impressive that a company of this size can grow their earnings consistently over a long period of
Yeah.
time. It's easy to do over a short period of time. Not easy, but easier. So it's quite impressive.
And with this, right, they have also been able to outpace the predicted average industry growth rates by a wide margin. So what this tells us, they continue also to cannibalize market share from others. Yeah.
Yeah.
So it is not just that the total addressable market continues to grow, also their share continues to grow. So yeah, I mean, a powerhouse. I mean, I think we got a question about Estee Lauder as an example, right? There are some of those companies that are just not doing well. Yeah.
Yeah.
And if you then look at a company here like these, then I mean, it's quite how is it? It's quite impressive if you can just continue to grow like this, building on others, taking other people's market share. Then yeah, respect to that. I give you an example, and this is data from late last year. Estee Lauder was actually declining in revenue. Shiseido had flat earnings. Yeah, while L'Oreal at that time was growing by 13%. Yeah, so I kind of feel like that I know whose lunch they were eating. Yeah, and that was definitely Estee Lauder at the time.
Yeah.
So yeah, impressive, really impressive.
So then to summarize the financials, then you're saying earnings per share is growing over double digits, 11%.
Yes.
Free cash flow is growing. There's no
Yeah,
debt.
exactly. They use opportunities to buy back some shares if they have some earnings windfall or something like that, but not to a large extent. And I would also not suggest doing that because we'll get later to the valuation, but their multiples are really high. So
Yeah.
I prefer them to keep the money in the pocket and buy businesses rather than their own shares, because I think the businesses, the brands they buy with their economies of scale and the additional sales that they can bring in, it's way more attractive than buying back your own shares here.
Yeah. And look, before we get on to the valuation, the dividend history, as we mentioned, 60 years of growth. But what did surprise me, and particularly from a European perspective, is most European companies that we've looked at have a distinct dividend policy. And it's easy to find. It's sometimes they
Yeah.
have their own page on the investor relations, but 9 times out of 10, you go onto the annual report and it'll be black and white. American companies don't tend to have the same clarity around the dividend policy, but then their actions speak louder than words in America. So I was quite surprised that L'Oreal didn't have a real mention of any dividend policy. I think you dug something out of a presentation back, that was 2014 or 15 or something, but it was quite difficult to find. But with that, I think, as I said, actions speak louder than words sometimes, and 6 decades of dividend growth is I mean, for a European company, I
Yeah.
think it's off the charts. So typically, and I think you mentioned this already, typically they distribute about 55% of their earnings, not from free cash flow. So I think the important metric to look at is the earnings per share. So as long as that is growing, you should expect the dividend to grow as well. And they've already increased the 10% this year to €6.60. So valuation, we know it's a good company. We've already discussed the balance sheet. We've already discussed the growth, some of the risks. So it all comes down to valuation with a company like this. And
Yeah, I'm a big fan of the discounted cash flow model, specifically for those companies. I truly believe that the sum of future cash flows, discounting to what money is worth today, is the best way of doing it, because that's effectively what you pay for it. Want to pay for a company. You can look at multiples. If you usually have a stable company here with predictable earnings growing, then you look at the multiple, usually you see like, oh, it's kind of similar, right? So there's also something to say for that. But if I, for instance, take here 6.1 billion in annual free cash flow, I think this is a little bit on the, well, let's say this is what they made last year, effectively like that. Yeah, this is what they made last year, and there's a company that continues to grow, so I don't feel like putting a margin of safety in there.
yeah,
Then I'll use a growth rate of 9% in the upcoming 5 years and 6% thereafter. Well, we know that the company has been growing by 11% and even 12 or 13% in 2023. I'm going to be a bit more conservative because I do see weaker consumer everywhere. Also, when we read annual reports and everything. So there is something going on there. So I have a feeling that the last 5 to 10 years of a decade, L'Oreal may not experience the next 5-10 years at the same rate. And what all this valuation about is assumptions. And these assumptions is often more an art than science.
yeah,
But the last thing we should do is just assume that the performance of the past we can easily extrapolate into the future. We really need to take context into consideration. So for me, 9% and 6% thereafter, I feel like that's achievable. I use a discount rate of 10% because I don't want to punish this company with a higher discount rate because it's doing the heavy lifting. For me, it's a growth company. So also here, I'm not putting any margin of safety for the high interest environment. If it would have lots of debt, I would probably ask for a discount rate of 12.5% because of the higher interest rates. But it is hardly any debt. So, and then I use a terminal multiple of 25. This is significantly lower than today. It's trading at a 40 PE, but I think for a very high quality company like L'Oreal, 25 is for me the max. So usually I go for 15 to 18 with a solid company, 20 for like really good quality company, high quality company. But I think L'Oreal is very unique, like Novo Nordisk probably, and a few of those others in the world. So I'm okay knowing in what world we live to give a 25 terminal multiple. Doing this, I come out at a fair value of around 300 euros. And we need to know that it's trading today at around 400 euros. So I would say that the company is still like 30% overvalued based on this. I also did this quick dividend discount model valuation. You could also argue like, hey, if the dividend is the only return you will ever see because you don't intend to sell, yeah, then effectively the dividend is our free cash flow. Now, if you take that into consideration and you take like an 8.5%, let's say, I think that's reasonable. It's around the 9% to 6% that I use for the other model. 8.5%, I come out at a fair value of around 400 euros. Now I take more, I said, trust in DCF for L'Oreal for the reasons I mentioned before. So I kind of stand by the estimated fair value that we did in our first newsletter of around 320 euros per share. I think it requires a bit of I said, a 10% drop in the overall stock market or something like that, or something to happen for the company to get there. But if it gets there, I will be probably buying it at around 320 euro. And yeah, that's my assessment of the fair value. I'm just wondering, like, how do you look at it? Do you have a similar perspective here, or would you use other assumptions here?
Yeah, it's quite funny because usually when it comes to valuations, then I'm a little bit more conservative than you are usually. And I was surprised to see you put in 9% and 6% because I would have chose probably 8 or 9%. I would choose and 6% I think is fair. So I think what you have there is quite fair. I wouldn't deviate too far from that. So anywhere 300 to 340, I would say is close enough to fair value for me. But what's interesting is you say that if it drops down to 320, you'll be buying, but it hasn't been there since 2021, I don't think.
And yeah, the what do you say? Stock market can stay
Yeah,
irrational for a
longer
long
than
time.
yeah,
Yeah,
yeah. But
longer than you can stay solvent. I think that's the one.
yeah, and what I'm thinking is that China is the key here, and for it to drop, I would imagine you'll have to have some major news around China deteriorating
Yeah,
regulation and so on. And if that happens, I wonder if the conviction is the same. Would
I
you
don't
still
know.
be?
Let's say like that. I have been waiting for 5 or 6 years on Nike, and you know I bought Nike a while ago for
Yeah,
the same
yeah,
reason. Yeah, so
yeah,
I've done my analysis. So if what the thing is about when something would happen, the question is can still grow 9% per year in the
yeah.
upcoming 5 years. That's the question at heart. Yeah. And it may be okay to have a one flat year, but if the overall trend is the same, then I would be okay buying it. I have learned over time to not let sentiment in the stock market influence too much my decision. What I may do is read the news and see what's happening there, but then go back to my thesis and see if it changes my thesis. That's why I feel quite comfortable buying a company like Nike or Starbucks after a 20% correction. While everyone gets scared in the market, I know what my thesis is. I see that nothing has changed. I had the patience, and what I most often see is just a reverse to the mean, multiple wise, because suddenly this growth story for the high growth investors is over. Yeah, so then they can hand back the shares to me at a much lower price than they ever acquired them.
Patience is key, but
Yeah, but I do own one share, by the way, right?
yeah, I
Because
know. Yeah,
after writing my article at the time, I did initiate a position by buying one share. So I'm the proud owner of a full share in L'Oreal.
yeah. And of course we have our own dividend safety algorithm that we run, and this scores quite impressively. 94 out of 100. I think you assigned it 92. You must have knocked 2 points off it because of China or something. I don't know why. But yeah, 94 out of 100 is I
Yeah.
mean,
Yeah,
pretty stiff.
it has just almost the maximum dividend safety score rating. So
As safe as it gets. So I think overall, what we're looking at is a quality business with lots of growth drivers, still lots of room to grow, strong balance sheet, good dividend history.
but with risk in its growth due to
Yeah,
the geopolitical tensions.
and price is overvalued.
Yes.
I think that's what we're saying.
Yeah.
And we are investors. We need to make money from this. And if you prefer just the dividends and dividend discount model, then yes, it's within buying range. But if you prefer cash flow, then you may be a little bit out of luck. So
Yeah.
we'll see. We'll see. It's I would like to see it drop. I would like to see it drop not because of fears in China. I would like to see it drop because of an overall market crash. And then
Yeah,
nothing
yeah,
is
changing market sentiment. I
yeah.
think that's what we need. And then analysts will say like you can't afford a 40 PE anymore for such a stock. The growth is over or something like that. That's what I'm waiting for.
Yeah.
And I will just compound it at that moment in time. Look, hey, this was our first newsletter last year, right? In September. So we've given also a bit of an update on it. We've done a business breakdown here for L'Oreal. I hope that our listeners enjoyed it. I think there's so much to talk about and to say about this company, but we are bound by time on our podcast, right? But look, it also gives a bit of a flavor to people like what we're writing about when we're doing a deep dive. So if people are interested in also becoming a premium subscriber, hey, try this newsletter out. These first 3 items are available for free on the website. So it's the L'Oreal, the British American Tobacco, and then Group. But I guess most of our listeners have tried them already. But if not, try it out, and yeah, you can always become a premium member as well. You will all find this on EuropeanDJI.com.
Yeah. Okay, listeners' questions. We got a few to get through, so I'll start with Abraham, and he says, "Why do you think that finance and investing is such an under-discussed subject in general?" I mean, money is hard to talk about. Not everybody earns the same. To be fair, everyone has a different opinion on it, and I think it's hard to share your thoughts
Yeah.
on money. I really do, especially when you come from different backgrounds, and we discussed different income levels. So
Yeah.
it's a hard subject. And even within your family, you have some people that do better than others. So it's a
Yeah,
tough subject.
jealousy kicks in as well, and or privacy. Yeah, you want to stay private about you because you don't want to create this jealousy or something like that. It's just
Yeah,
a lot of taboos around this topic. So and also like people have already enough worries in life often,
yeah,
and I would argue that more often finance follows the regular problems in life
yes,
rather than finance creating the problems. Although people might feel that their debt creates their problems in life, the first question you may ask is like, why do I have so much debt? Yeah.
yeah,
I think it's just a difficult. I just think it's a difficult topic, but I think personal finance are typically easiest discussed with people you don't know.
yeah,
Yeah, like on a blog anonymously, and I think that's good that we have the internet nowadays because it has actually opened up a lot of opportunities for people to start taking matters in their own hand, to learn from others, to openly discuss in it without releasing their identities. So I think it's generally been a good time today compared to, let's say, 50 years ago.
yeah,
But I don't expect a lot. Also, when you think about financial education, I do I do think that there is attention to it to school, but I always wonder, like, imagine you're a kid of 14, 15, and you see a nice lady sitting beside you. You want to buy them L'Oreal lipstick. You don't want to listen to the teacher talking about annuities and these kinds of things, right?
yeah,
So I think that's where the heart of the issue is.
yeah,
And after that, they're at university. Yeah. So then they are specializing into a topic. So yeah, I think
yeah,
that's just it.
yeah. Adrian has wrote to us. He said, "I have my first baby, a boy, coming this week, and I posted this on the 8th of July. So I hope if you have already had the baby, I hope the baby is healthy, and congratulations to you and your partner." The question he's asking is, how should I expect expenses to change over time? I think we discussed a little bit about this last week.
Yeah.
Will I still be able to maintain the current savings rate? Nope. And what is your experience with this? And do you have some tips to save money while not being a cheap parent?
Yes, the first tip that I would have is like try to avoid being such a project parents. What I mean with project parents, that how I say you want, you know, I mean, we talk about car salesmen, yeah.
Yeah.
Go when you're pregnant to a store where you need to buy such a, how do you call it, such a little wagon for your kid.
Oh my God.
They are worse than car salesmen. I mean, they really start to talk on your feelings and what you all need to have as a baby, and then you have your wife full of hormones standing beside you. Do you really think this person cares about money at that moment in time? And the salesmen know this in these stores, right? So you buy everything. My recommendation really is like there's so much stuff that you can buy secondhand. It's not about cheap, but even the big brands, there's so much you can buy secondhand. For instance, think about these. How do you call such a wagon where you put your baby in? How do you call this?
We call it a pram or a buggy.
Yeah, a buggy. Let's say a buggy.
Yeah.
I mean, many of those buggies still look really good, but you can, for instance, just buy the clothing of the buggy. You can just buy them online again. Yeah. And it looks like brand new. I think this is where you can save a lot of money in these kinds of things. And the question is also like, for who are you buying this? Do
Yeah.
you really think your baby remembers this? I
Yes.
don't. No, F off. I remember nothing of my first 4 years in my life. I don't remember anything that I ever got or
I was,
received.
I was saying yes to agree with you.
Okay. So, if the baby doesn't remember, and I think we will all agree on that one, that the babies won't
Yeah,
remember. For who are you doing it? It's for yourself. You want to look picture perfect
yeah,
when you're walking to the park. Yeah, you want to impress the others around it. It's yourself who you're satisfying with this. And then ask yourself the question, is it worth to pay like easily €1,000 for a buggy for
yeah,
that?
yeah.
Really? Really?
It's the same. It's the same with clothes because they grow out of clothes so quickly that first year. I mean, you could buy naught to 3 months, and by the time they're 1 month old, they're already in 6 months old. So, yeah, I think there's plenty of ways to save money. I agree with the pram one. Our pram or buggy was €50 second hand. It was used on our two kids, so and it was perfect. My sister bought a pram for over $1,000. It
Yeah.
was crazy, and I mean, I've rolled both prams.
Yeah.
It made no difference because I was still able to get the baby from point A to point B. So
Exactly. And I think also about buying the first bike. Yeah,
yeah,
we got
yeah,
the bike from the cousin. When those kids are falling all the time, for me, when they get a brand new bike, was when they were a bit older. For instance, their first communion or something like that. Yeah, then the kids are also more aware. You start to buy newer products, I would say.
mm,
But the first 4 or 5 years, I would say anything that has nothing to do with hygiene, I would say like look on Facebook Marketplace or whatever and buy this stuff. Anything that is from plastic, like the car seat, the Isofix, you can buy this stuff for a third of the price online. And if it has any fabric or something like that, usually you can just buy it as spare parts online, and you have a totally new. Your wife wouldn't even be able to see the difference.
Manny Mystery has asked us about allocating a small percentage of our portfolio to value punts. Let's say 1 or 2%. So like turnaround place.
Yeah.
What criteria would you use on a filter to find companies that were value plays and not necessarily dividend paying companies?
Well, I would probably go for a PEG ratio under 1,
Okay.
PEG, because that shows you that there's still growth expected behind it, according to the analysts, but that the earnings multiple is really suppressed. I think that would be the number one that I would really, really look at. And then I would do that in combination with a strong balance sheet.
Yeah.
So then you know that this company has also flexibility. I would screen for that. Just those two, a PEG ratio and a strong balance sheet. So let's say a debt equity below 60%, something like that. Yeah, that's what I would screen for. And yeah, see what comes out of it. And based on that, start looking maybe still at return on invested capital if you want to, because maybe they come 200 stocks out of it. Start adding return on invested capital above 12%, I would say. And then when you have 20 stocks left or something like that, I would just go to the stock and try to understand why it is valued, because there's usually a story behind it.
Yeah. This is not a question, but I found this quite funny on Facebook. So Marcus commented, I think 2 weeks ago, I was complaining about it being 13 degrees in June in Ireland.
And we did
Yeah.
this portfolio last weekend.
Yeah, yeah.
Review.
And you had a little moan about it being dark in Poland. So he has two quotes. He has, the darkness in Poland is just devastating, ... Well, what about Ireland? It's 13 degrees in June, ... Finland, hold my beer. He gets the best of both. Dark and cold. That gave me a chuckle. Richard has asked us about his OCD. He said he only purchases whole shares, not fractional, as he likes to have rounded numbers of total shares in my portfolio: 5, 10, 25, 100. Do you have any quirks like this?
Well, actually, yes, I also like round numbers. So usually when I'm building positions, I don't do less than 5, and preferably 10, and even more preferably on the 100. But it depends on the market price. Except for L'Oreal, sometimes I buy one share when for those reasons when they are quite expensive. But I have something similar. But it's also with my acquisition price. I usually want to buy them at a round number, but then I'm afraid, for instance, everyone wants it around numbers. So then I do like, I don't know, 50 euros and 2 cents. Yeah. But more lately, I started to just buy directly in the market because sometimes I was just waiting, and then a company that I wanted to own flew away, and felt like penny wise, pound foolish. But this kind of thing of also needing to acquire and round numbers is also with me.
Yeah, I'm the same. The only difference is I could not buy 5 or 25. It has to be even and round numbers. I could not have 5 or 25. It just
You need
bug
to
me.
have like 6 or 8.
I'd have to have 6, 8, 26. Yeah, and I always want to aim for 100 shares. Sometimes it's not possible, but I'd rather own 100 shares. But yeah, like 25 is odd numbers. I can't do it. It just feels weird.
Oh, nice one,
Um,
Richard. Thanks for sharing.
Terry has asked us about National Grid. What do you think of them?
Well, I looked at them a few times and I just didn't like what I saw. I also don't believe, no, let's say differently. I also don't understand the UK grid well enough. I got a feeling for UK wind, right, here as investment trust, but National Grid, no, I mean, I can't give you any more exactly the details. I don't even remember anymore about the dividends. I remember it was a high yield payer, but those 2-3 times that I looked at it made me not want to buy it.
Yeah, I know they were in the news lately. They had share price drop, and I've never looked at them in great detail. I have other utilities in my portfolio as well, so I just kind of stay away. But from that time they were in the news when they did drop, it looked like a lot of people were confident in the business. I think
Yeah.
look, it's probably nationalized, or at least the government owns a percentage of it, so it's probably safe. We've now got a Labour government in the UK, which usually it's going to favor UK wind as well, by the way.
Yeah.
But it'll favor National Grid as well and things like this. So yeah, I mean, look, I don't know. It has potential, but I have other things in my portfolio, so it's not on my
Yeah.
watch list. El Cuba has asked us about European consumer staples, the likes of Tesco, Geronimo Martins, and
Yeah.
Carrefour.
Yeah, so Tesco is really on my never touch list. I remember like 8 or 10 years ago when this business was in heavy trouble in the UK, they were really lying to their investors. They were painting the grass green, and in the end, they ended up in deep trouble, had to cut the dividends. So, you know, once you have had to deal with such a company, I'm staying away. It may need another few years of demonstration. I mean, you could argue that Ahold also in the beginning of the centuries did a fraud. Well, it took a while for them to regain trust as a solid business. They turned it around, solid management now. I don't have the feeling for Tesco yet. When I think about Geronimo Martins, they own Biedronka, if I remember correctly, here in Poland, but I don't find it a reliable dividend grower. And the third one I haven't really looked at, Carrefour.
Carrefour, yeah. I was actually in one of their supermarkets for the first time ever last week when I was in Spain, and it was huge. You could buy everything there, like everything, all in the one spot.
These are the French mega stores.
It was annoying because all I wanted was bread and milk, and I had to walk half the store to get to it. But it had absolutely everything.
But you made your 10,000 steps.
I made 20,000 steps a day at least.
Well, look at that.
But yeah, I'm similar to you with Tesco, not because of the investor point of view, but more from employee and customer point of view. Obviously, they're quite big over in the UK and Ireland, but every single time I was going to the UK, I just remember protests outside. Employees weren't happy, they weren't earning enough, or they were not getting holidays. There was always some negativity around the company, and I feel like if you're getting that from your employees constantly, there's something broken in the company. I understand you can have it every now and again, but this was like non-stop. So yeah, it's a stay away from me. MMAC has asked us about Diageo. He's looking at their balance sheet. He doesn't like that they buy back their shares at high valuation instead of paying down debt. But on the other hand, he says valuation now seems to be reasonable, and he likes the direction towards premiumization of the portfolio. What do you think about him?
I have little conviction for the stock. I mean, I like some of their brands, but he touches on few of the things that I also saw, which I simply don't like. So I need to build in a much higher margin of safety, and I think the company is still far away from that.
Yeah, I I think we mentioned that something similar to what you're saying. I'm not chuffed that they're buying back their shares at a high valuation, considering the amount of debt they had on the portfolio. I still don't think their valuation is reasonable. I think
Exactly.
I think they're at a premium. So yeah, their shift towards premiumization, they're not alone in that. Lots of these companies are doing the same. Essentially, what they're doing is fooling us consumers to thinking that beer is somehow more valuable when it's container in some other way. It's crazy. Actually, funny story. We're had a few drinks on Saturday. It's the first time I've been in a pub in Ireland in a while, but it's not at a function, and you expect to pay premium price at a function. This was just in a general pub, one of the ones I brought you to, actually.
Yeah.
But a pint of Peroni was over €7 for 1 pint.
Wow.
That's crazy. Like, it used to be €4, maybe around the pandemic. Like, it's
It's still the same beer.
Still the same beer. It hasn't changed. So pricing has
Yeah, I
gone
think
through the
this
roof.
is what matters to men, right? The price of beer. That's how we measure inflation.
Yes, yes, and it's after going up quite a bit.
Yeah. Did they also do shrinkflation, like that they sell it as a pint, but they pour less into it, like
Yes,
smaller
yes.
glasses?
The glasses look a little bit smaller, and now they've started selling half a pint, but it's not half a pint. It's slightly less than half a pint, but they're charging you more than half the price. And you're kind of going, piss off. Get a man's drink.
Shrinkflation, even in the beer industry. Oh my God. I mean, this world is doomed. We're like on a path of no return.
Hens de Jong has asked us about, he posted a chart, but he's saying the chart of a Monday Euro government inflation linked bond, ETF, you get below. He said it doesn't look too pretty, right? You use these in your
No,
your
not at
portfolio.
all. No, I mean, a Euro government inflation linked bond UCITS ETF. I mean, if you can't remember what you're reading, it's probably not not good
Yeah,
enough.
it was hard for me to
This
even
is not
read that.
like a dividend growers ETF. Yeah, no, the Euro government inflation linked bonds accumulating. So no, Hans. I understand why you're thinking about it. If you want to have a certain percentage of your portfolio in bonds, but no. In that case, I would, and I know it's probably on the too hard pile, Hans, but I would then probably go directly into bonds. Yeah, just buy the Dutch government bond.
Tim Ainley has asked us, what is your favorite holiday dividend stock? So you go away, sleep well at night, and you know it's grown while someone else is on the beach.
Ahold.
I quite like Evolution Gaming now, I have to say. I'm
Yeah.
getting quite bullish on that. Yeah,
The gambling is
the gambling in me is it's luring me in. Adrian has said, aside from Legal in General and Unilever, what are some other UK dividend growers that I should look at taking a new position in?
Well, I think you mentioned one the other day, right? Greg's.
Oh, Greg's, of course. I'm really bullish on Greg's. I think Greg's is definitely one to look at. If you're just looking at dividend growers, I think British American Tobacco is worth a look. I mentioned UK Wind because, especially now that Labour in government, I think the UK has some stocks, and the market overall seems to be looking a little bit more positive as well. So let me know what you look at. And then the last question is from Mark. And he listened to a podcast about Starbucks and Howard Schultz and how his succession planning hasn't gone too well, and he has to keep coming back to the company. But what do you think about what will happen when he can no longer come back?
Well, that's what we're seeing in front of us now. Yeah, so he was he was maybe not the founder, but kind of the one who built this whole company up from the ground. I think this is an issue. Yeah, we've also seen with Bob Iger at Disney struggled also to find a good successor.
Yeah.
So this is one of the biggest issues, in my opinion, that Starbucks is facing. Forget about China and this. The real reason is the CEO. He looked so much like a fool, right? After those earnings. I mean, the interview on CNBC, was it with Jim Cramer at the time? I don't remember exactly, but oh my god, I felt so painful watching it. I felt so bad for him. I wondered, like, sometimes at work when you have a bad day, that you're in the at evening, you can't fall asleep sometimes because you're wondering. Imagine what this CEO had to go through. Even though he has maybe a few million in remuneration waiting for him, I think it's still a human being. Imagine there.
Yeah.
What is he thinking? Yeah, like, oh my God, now Howard Schultz, what will he say tomorrow in the media?
I
Yeah,
mean,
yeah.
yeah,
So I don't think there's underlying a fundamental issue with Starbucks, but I think the CEO matters in this case, like how much growth you expect in the upcoming years, and yeah, it's he's big shoes to fill.
big shoes. Yeah. And I think Mike is right. Howard was all about the experience. And I think that's what made Starbucks so good. That experience
Yeah,
of going to Starbucks and
but
others.
we need a new CEO with its own vision. I give you an example. We had Bill Gates, Microsoft.
Yes.
Steve Ballmer came in. Mistake after mistake after mistake. Yeah. Microsoft was flat for 15 years or something like that. They purchased Nokia, yeah, as an example. But what Steve Ballmer was doing was just like ego tripping and trying to be better than Bill Gates, taking more on risk, but he was still kind of doing the same like what Bill Gates was doing with Microsoft. But then you needed to have really someone like Satya Nadella to come with its own refreshing vision about the company, with some catalysts arising, like the clouds, yeah, to turn this company into its next leg of growth. But Steve Ballmer would have failed in the clouds because, for instance, he was not open to the ecosystem. Satya Nadella was. Da 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 da. I think
Yeah.
this is what Starbucks needs as well. I see this as an in between pope. I don't know what the good translation is in English, but such a transitionary pope in
Yeah.
Starbucks. But they need kind of a proper, hopefully homegrown, talented person. And this is what I think they need to look at. They need to look at talent and not at the regular old timers that are there and the old boys network. No, start to look more at the data. Who's really the person that is creative, has a drive, has this hunger? Not those all the management board with the gray hairs that are protecting the status quo. Yeah, put them with the furniture and the dead wood. But look at those talented ones that are really having an edge. This would be my advice to the board of management who is deciding about the next CEO at Starbucks.
Nice one. So that's the last question of the show. So thanks again to all the guys for asking
Oh,
those.
by the way, this advice, Starbucks can send me a bill for 1 million. Yeah. It's the same as when they ask for a new logo. They take an agency, takes 3 million. I mean, I just gave them a McKinsey advice. Yeah. 1 million at least.
What was the logo that didn't change? It was like a million. It was a European company. Or was a Pepsi?
Yeah.
I can't remember.
Yeah. It was like they fiddled a little bit with the color, but it still looked the same.
Yeah, I can't remember.
Yeah.
That's pretty much what this is. Sack your man, get a new CEO in.
Yeah. Or Johnson and Johnson taking away the iconic logo of the founder's signature and then replacing it with a digital ready font type that is easy for the eyes to read on a screen. What the hell, 100 something years of history down the drain because of one digital agency.
Yeah, who probably made a fortune off that.
Yes, of course. The only thing they did was like right hand mouse button change to Verdana or something like that.
Oh, we're in the wrong job.
Oh, definitely.
Okay, buddy, enjoy your break.
You too. You
Well
too.
deserved break, and we'll talk to
Yeah.
you all soon.
And use Vicky.
Yes.
See ya.
I'll try my best. Bye. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.